Hi, everyone, and welcome to Bitcoin Analysis Beyond the Block for March 2024, brought to you by Ainslie Crypto. My name's Chris, and today we have assembled a great panel of experts to update us on where we are in the Bitcoin cycle with some analysis and discussion looking at the macro fundamentals, market and on-chain technicals, and everything else in between. How are you going today, team?
Pretty good. Really looking forward to doing this video.
Hey, Chris. Yeah, really looking forward
Yeah,
to it as well.
good to see you again. Now, we had some excellent feedback and discussion in the community from people last month. So this is our second month of putting this full video together. And that was really valuable. Keep that coming in those wherever you saw it, whether it was on YouTube or on X or wherever it was. Keep that feedback coming because we really appreciate that. And it does guide what we're doing here. But I'll just sort of start off, I think, by reminding everyone what the framework is that we are actually adopting here. And that is to look at the big picture macro first, to sort of get that big idea of what's going on in the macroeconomy, because that then drives the specifics of the Bitcoin market analysis. And there has been tons going on in Bitcoin this last month. So lots and lots to talk about today. From that, then we will dig into the nuts and bolts of the technical analysis. And that's really, where it's Isaac's time to shine and sort of show us some of the charts and things that he's brought along. So it's a great way to do it, I think. I think people really appreciated that last time and really gives us a framework to see the whole picture, which is quite important because if you look at any one part of that, you don't really get to see the whole thing of what's going on. So I'm keen to sort of go down that path again. Like I say, give us feedback if you don't understand or want to see something different or whatever, but we'll continue along that process for the time being because that seems to work for us. So let's start off. We're looking at the macroeconomic analysis, the really big picture stuff, and we'll bring up this chart, which is our global macro cycle indicator. It's got February 2024 on there. That's not a mistake. That's deliberate. So that's the data up until really the February data, and we don't have the March data on that yet. That will come out quite soon, and then we update as we go. So we're always keeping up to date, and the latest view of any chart you see today is the latest view that we have. So can we maybe start off by just a big picture overview of what this graph is showing for people who might not be familiar?
Yeah, so
I'll go
I'll
start. Yeah.
So basically, what we've got here is the cycle, the economic cycles. You got bust obviously in red, early, mid cycle, and late cycle. As most people would remember, 2021 was the peak of the Bitcoin cycle and markets in general. We got into 2022, and the Fed started to raise rates, liquidity started being removed from the system, and asset prices started to go down. Towards the end of that year, 2022, we went through the bust phase. The bust phase is where the markets generally bottom. That's where liquidity usually bottoms, and that's where the point of most opportunity to buy assets should be taken for the most gain over the corresponding 12 to 24 months. We're now moving into early to mid cycle, so we've actually dipped back into early cycle, which is not a bad thing. But from here, we would expect economic growth to continue and asset prices to continue to rise. Probably not as quickly as they have from the bottom of the bust cycle, but still gains to be had.
And we'll talk about that a bit later because it certainly lines up with some of the stuff that's in the liquidity cycle. But we made the point last month, and I'll reiterate it again, that we might have dipped into, or it seemed like we sort of popped up into that mid-cycle here, but it was really a little bit early. This is us just reflecting what the data tells us, right? So at the end of the day, we show what the data says. And the data at that point was saying, well, it was looking more mid-cycle-ish, but we're back in early. Early makes more sense for where we are currently, particularly when we look at it against the bigger picture. And Isaac, I might pull you in on this next chart because this is specifically it's the same concept as what we just looked at with that macro cycle generally, but this is applying it specifically to crypto and Bitcoin in particular. So can you maybe just talk us through how the macro cycle looks through that Bitcoin lens?
Yeah. So this one is really good because I feel like it encompasses the 4-year cycle quite well, especially with the coloration. We've got spring, all that's there. So right now, where we are now, going into summer, which we've entered that region, I also want to preface saying it's not, you don't have to be charging up straight away right now. As we've seen in the previous cycles, you can have consolidations and dips here. And especially right now, a lot of people are freaking out, thinking, that's the end of the cycle's topped out here. But looking at what we're going to cover, next with global liquidity, it's you shouldn't be doing that. You should be looking at where we are in the cycle and looking at that macro backdrop to give you that framework. So yeah, we're entering that region, and this is a region of growth and consolidation, in my opinion. And then obviously heading into that fall, you can expect to see some pretty crazy euphoric gains, as you can see in the previous cycles there.
And that's such an interesting way to look at it as well, because fall, which kind of aligns with what we were saying as late cycle in our broader macro view, is the area where the economy is starting to roll over, yet we traditionally have seen the biggest gains actually come from that in the Bitcoin cycle in particular. So very interesting there. We should also sort of probably point out here that this is just saying that each year is a season, right? So there's not the nuance, I suppose, of our previous chart when you're looking at it that way, but you can certainly see it working, right? Like we pretty much topped perfectly and had, particularly if you just look at the blue there, the winters, they're pretty well aligned with the full calendar year. So whether that remains the case, I mean, do you have an opinion on that? Whether this is long term remains so precisely cyclical?
Well, it's arbitrary, like yearly, but sorry to cut you off, mate, but as Tibber said, you've got the peaks right at the end of autumn, but it's not just that, you've also got the bottoms right at the end of winter.
Yeah, I was going to say the same thing. Just looking at that, it tends to follow quite well, especially winter. Just you can see the bear markets dragged out through that time period, and looking at it, it's crazy accurate. And tying that in with the global liquidity, it gives you that really good framework to go off. So where we are now, it's not a region to be panicking, in my opinion, as a lot of people are doing. So I would like to step back and just look at the big picture here. That's the main thing.
And we'll certainly, I mean, we're going to dig into a lot more of those charts that will give us those specifics. But yeah, really good point. And when people are talking about, oh, this cycle could be different, it absolutely could be. And that's kind of the point I was trying to lead to. It could be different, and we might not see that 1 year down, 3 year up scenarios. So we may end up needing to go back to our previous chart where we're looking at the macro cycles a little bit more in a nuanced way. But certainly it hasn't broken so far. So, that's something to keep into consideration. Just to sort of look at this from a slightly different angle, we also look at growth, and the US isn't the whole world. Like, the first thing we need to say about this, we like to zoom in on the US specifically because it's obviously a very major economy, and what happens in the US does impact the rest of the world, particularly in this space. But Joe, do you want to just maybe give us a bit of an overview of what this actually is that we're looking at here? Because we've got, first of all, this chart, which is the 1 month, US growth, which is the ISM Manufacturing Purchases Managers Index down the bottom in the blue, and we've got this sort of lead indicator sitting over top. We also look at it a little bit further ahead on this chart here with the sort of 3 month leading indicator. But what is this overall? Start us off with 1 month, and then we'll look at that other 3 month one as well.
Yeah, so as you said, this is US based data. The data comes from the top 300 companies within the US for producers, sorry. So they go around surveying and they get expectations of where and the harder of what they're actually producing. If you look at what we've got there, the blue line is where we are now, or last month's data. We've been anything under 50 is contraction, so we're still actually under 50.
And that's that 50 line right there, yeah.
Yeah, straight through there. So last month we were predicting potentially a jump into expansion. That hasn't occurred. So we're once again consolidating under 50, which is not necessarily a bad thing either. We've got excellent performance in asset prices while we're still technically in a contraction. So at some point, when the government, specifically the US government and the global, wants to stimulate growth, the ISM will turn up, and that effectively just means more money into the system.
And traditionally, the ISM does spend most of its time above 50, right? That's the point, really. You want your economy growing. I mean, the fact that it's below 50 and we've avoided a recession is fascinating in itself, right? Like that's generally the indicator of the recession, is that growth is below that 50 line. But what we are seeing here as well with this leading indicator on the 1 month time frame at least is it's not really breaking down. So even though we have had that down, we don't necessarily expect that to continue. And even more so if we look a little bit further out, when you start using the concept of a 3 month leading indicator on here, And what generally tends to happen following that, the bottom was clearly, aligned with the bottom, and it's only been moving upwards since. So generally, that's a good sign, yeah.
And that aligns with the early and mid-cycle analysis in the first slide as well. We'd expect to, as we move out of the early to mid, for the ISM to tick up and growth to continue.
So this is very different to what we hear a lot of people talking about when they sort of worry that growth is heading down further or whatever. We're saying that, well, really, it's already headed down. You can see it quite clearly. We've had a long period over many months of the economy contracting, and now we're arguing the bottom is probably in place and expanding. And that leads us very nicely into the concept of global liquidity. And this is one that we're very, it forms the foundation of everything that we do, because really because of this chart that's up here now, and I'll just explain this a little bit. This chart here is saying global liquidity and world financial asset prices are very highly correlated. And you can see it visually there. You also can use these statistical causality tests to see that it absolutely is. And the specifics are down here where it says the probability of it not being caused by that is effectively nothing. So we know that what is driving asset prices is global liquidity. So that becomes an important part of the analysis. When we look at what global liquidity actually is, this next slide highlights it really nicely. It's how much money is in the system. And we've had record after record being hit. This is weekly data that we've only just started producing. So we didn't have this this chart in last month, but it's been really popular. People looking at this to say there's the $171 trillion mark of global liquidity that exists in the system. And we've just hit record after record as that number keeps pushing up. So that is what causes the underlying that we saw in this last chart, the underlying correlation with asset prices. More money in the system, which is liquidity, means that we're going to have that money need to go somewhere, and it tends to find its way into asset prices. I think this chart explains it really well. Joe, do you want to give us a bit of an overview of what's going on here?
Yeah, so black line is global liquidity. Yellow line is the value of crypto and gold. And up down the bottom there in the dotted line, you've got US CPI. So as we're actually a little bit ahead. Well, the black line is forward-looking, of course, because we're into 2025 there. The yellow line is currently a little bit above what global liquidity is indicating what a fair value for crypto and gold is, but that also does not mean that we can't get ahead of ourselves a lot further. Like particularly if you start referencing 2007 to 2011.
Yep.
And I'm sure you have more to say on this as well, Chris, but that was, if everyone remembers back to that period where QE had just started, there was the banks being bailed out. That was effectively a debt crisis, and we saw the markets get well ahead of themselves in terms of liquidity. So we could all argue that we're potentially moving into that period as well right now, and we could see gold and crypto pricing far outpace global liquidity, even though we expect global liquidity to continue rising as well.
And gold and crypto, the reason why we specifically look at these is because they ultimately are monetary inflation hedges. They're the assets that most accurately represent what we're seeing in the increase in global liquidity. So basically the debasement of currency. They're the two assets that do that the best. Yes, all assets do it, but these two do it almost in a one-to-one type fashion, even though exactly what you just argued, potentially starting to move ahead of that line here. I would argue, well, just on that point, this is quite interesting, because when you look at how much the markets took off here because they were starting to think the debt was getting out of control as it was raising through this level, what can this line do when it sees that we're starting to go hockey stick vertical in the projections and what we're really seeing happening day to day with that previous chart, even on the weekly, with the liquidity that's been in the system now? Like, it's, yes, that might be above, but was this pulled down because ultimately it was brought under control? I'm not sure this will be brought under control like that. And as people start to panic, that could go spiraling off. So it's pretty powerful stuff.
Well, also remembering that Bitcoin wasn't an asset class in 2009, 2010. So that's effectively just all gold. Everyone piling into gold.
Yeah,
now we have
until at least
gold
here. Yeah.
That's right. Well, that was gold. It had a very large run up from 2000. the price got far too ahead of itself, and that's that correction that we've seen and we've been through for the past decade. We're potentially moving back into that period again with between 2000 and 2011.
Really powerful stuff to think about in terms of, just because often people go, well, gold didn't perform very well for this period of time. Well, it's not that it didn't perform very well. It's just that it was returning to where it needed to be and then continued on its path. Like, this graph is so powerful, I think.
Yeah. And also, I think you would want to touch on the CPI as well, Chris.
This dotted line, yeah, yep.
Yeah. So generally speaking, that raises at about 2.5% a year, like just on average, we'll call it. But that really illustrates the difference between the inflation in CPI and asset price inflation. So whilst CPI is 2.5%, what people really want to own is assets. And every year that you don't own assets, they're getting more and more expensive, because that yellow line is rising faster than 2.5% a year over time.
And it's the only thing these assets kept up, and that's the whole point, right? They're doing their job. Gold and Bitcoin, they're doing their job of just keeping up with that line, because your wages certainly didn't keep up because they'd be reflecting this CPI line, which is not kept up with what's happened overall. We tend to look at the fact that there are cycles within this global liquidity creation. It's not just a straight up, well, it is effectively straight up and to the right, but if you can take advantage of the cyclical nature of what happens in between that, you can actually make a lot of money, which is ultimately what we're all here to do. So, Isaac, do you want to talk a little bit about this chart?
Yeah. So as you can see, they've overlaid the sine wave on top, and what you've seen in the past is it's typically trough to trough. It's been pretty accurate. So we run these cycles, as you can see here, 5 to 6 year cycles, and you know, looking where we are right now, we've seen quite a large rise up to the 40th percentile in the index. So yeah, small reduction now for global liquidity, which also reflects the crypto price right now, specifically Bitcoin. But, you know, we still have a long way to go. Whether we hit the 100 on the index or the 90 or the 80, that's besides the point. We still have a long way to go. We have to hit 50 and then, you know, 60, 70. But that also means a lot of appreciation, specifically for Bitcoin, once we start reaching those levels. And a lot of people are worrying right now, but I don't think there's any reason to worry, because global liquidity can also have a consolidation phase too. That doesn't have to be going up in a straight line non-stop, as you can see with the chart.
Yes, and this chart, this next chart, which is really the same concept, but just showing it a little bit more directly, isn't it?
Yeah, it's just showing that visualization of what's happening. We're coming out of that red section, which is the liquidity is very low, and we're starting to get to the green section, which means just from a visual viewpoint that we're heading into more liquidity in the system.
Absolutely.
So the next 12 to 18 months will start looking like the end of 2021.
Where you start to see it all turning back green again. And that, I'll just flip back to that previous chart. That's what this looks like, right? Like, you're seeing this happening in real time through the colors. You're seeing, we go through one phase, then we go through the other phase, then we go through I did that back to front, the out phase, then the down phase, then we'll go through the up phase again. So the predictable nature of that, and I would argue it's becoming more predictable because of the graph we looked at before, where it was just so out of control that the liquidity just keeps going up and up and up. That makes something that we can really work with, which brings us to starting to look at that through the lens of Bitcoin specifically. So maybe, Isaac, do you want to maybe tell us just a big picture overview of what we're looking at here?
Yeah, right now, as you can see, with what I said before, you can see the global liquidity, which is starting to go down a little bit. Nothing to worry about though, this normal consolidation. And obviously crypto has started to consolidate too. I think the cryptocurrency, Bitcoin specifically, shot up really high to the all-time high. And now we've seen that pullback, right? So as you can see, there's a divergence there, right? So global liquidity was tanking, well, not tanking, just decreasing, whilst the crypto was rising heavily. And that's that divergence there, but that's perfectly fine. I think it's perfectly normal. And yeah, I would say that's perfectly fine.
Joe, what do you think of that divergence? Like, what is that actually saying to you?
Well, the chart's slightly out of date. Of course, we're a little bit higher than 50,000 at the moment. But in any cycle, there's going to be ebbs and flows of liquidity, and the markets will generally react to that, whether you get pullbacks or sideways action. I would argue that exactly like Isaac's just stated, we definitely got a little bit ahead of ourselves, particularly if you're looking at Bitcoin. And it was only natural that we're going to get this current pullback that we're in.
And we will talk about this a little bit more because we got some slides that highlight this. But just to reiterate what this chart actually says, that is the average price of the month. So this chart, the March chart, has the data up to February because that's where we've got the global liquidity data to. But it's very interesting that we saw that little bit of pullback in global liquidity, and then we started to see a top being in place there. It does correlate very highly, which is part of the reason we rely so heavily on it.
Yeah, I think another key point I'd like to add is it's really just the general direction of global liquidity. Of course, it can fluctuate, as Joey said. It's what's the general direction of liquidity doing, and as we can see, it's going up.
And
some people will try to get
reason to think that we're coming back to those lows, particularly with some of the other macro things that we know are going on in the world right now.
Yeah.
Some people will try and trade that. They'll ask, why don't we try and trade that? Well, there's always the chance that you can trade that as well. But like as Isaac said, it's the trend. We're interested in the trend. We're not the pullbacks here and there in the secular trend. Don't worry us too much. We're in for the long haul.
That's right, and we want to be there when we're up in this green. We don't want to be flinching when we're still well and truly down in the reds and oranges. All right, so using our big picture framework, we've sort of covered that macro big picture analysis side of it. Now we start getting into Bitcoin markets specifically to look at some of the ins and outs of what's going on there. So Isaac, I'll get you to start us off. You talked about the charts that we were about to look at last month. I'll get you to run us through them again and really highlight what's changed with just a quick overview for people who might be new to them about what we're looking at.
Yeah, so right now we have the MVRV Z score chart. So essentially what this chart is telling us is the realized price, which is the blue line you can see at the top there, and the market price. So I'll just quickly explain the realized price. It's essentially an aggregate of the average holder, long-term holder, essentially, is a broad term for it. So view it like that. And as you can see, the deviation that we're currently seeing is represented on the y-axis on the right side, which is the MVRV Z score. So the 0, 2, 4, 6, 8, 10, as you can see there, with the Bitcoin hitting around 10 at its peak. And obviously with the 2021 cycle, we hit around, the 6.5 mark. And what I've done here with that red line, I've drawn that to sort of give you a picture to say, it's the deviations as the adoption's growing and there's more people in the system, in the network, it probably will go down, obviously, as we go further and further along on the curve of adoption, right? So as you can see there, it's extrapolating that forward. You're looking at around the 5.5 region, 5 region as a region for a potential top out. And by the looks of it, we're really only like halfway right now, sitting around 2.3-ish, I guess you could say. But I think what's really good about this is where we are now is if we start to consolidate now, we could push that realized price up higher to give us a better basis to push forward more. So looking at that, it's perfect. Now, I also want to explain a bit more as with this chart. As you can see, when the deviation becomes 0, it means a lot of people are actually in losses. And that's actually good region to be looking to buy because as you can see here, look at it. Just visually, you can see it takes off from there, consolidates for a few months around that region before it takes off. And it's only in there for a bit. So that's your time to really snatch up some Bitcoin. And the good thing is that also tied in with the framework, which we've been going over, which is the global liquidity. Around that region, global liquidity was at the lows and it was in that red region. So it's just perfect for it. So you got to use these to your best ability, but you also got to match them with the other frameworks, not just rely solely on it.
And that's a really good point because it gives us another tool in the belt to be able to back up what we believe is our core thesis that all of this is being predictably driven by things like global liquidity. So I think that's really powerful. If you've got another chart here that's another tool in that arsenal, can you explain this for us?
Yeah, so it's essentially using the same metrics, but it's just giving it in these categories: euphoria, greed, belief, optimism. You got hope and fear, and capitulation, which is down in that green section here. So it's essentially saying how many people are holding paper profits, unrealized profits, you could say. So right now we're in we're in belief, right? We're in the belief phase. So we can definitely see it to retrace from here, as we saw with the if you go back to 2020, that region there, yeah. So just the top there, yeah, around that region there, we saw that reduction in price, and then from there we went back up again. So it's perfectly fine to sit here and fall down from here. And it would honestly be the best thing, I think, for price to create that support floor for a push up when we go, opposed to just charging straight up from now. There's no real regions where we're going to develop that nice range. So, we're entering that region now. I would preferably like to see it start to fall down from here. But yeah, when we enter those regions like euphoria and greed, like the previous cycles, that's typically signaling a top.
And you can see that very consistently when it's peaked or popped its head up into that, is, or very close to it at least, is where we've then had significant pullbacks, and we're certainly not there yet.
Yeah, and you can see with the capitulation side there too, that also matches with the MVRV and global liquidity, which is another good thing to look at.
So all these tools coming together, and I know this is actually a really interesting one because, like it says, it's saying combination chart. It actually pulls a lot of these things together.
Yeah, so this one's got a lot. It's got the pi cycle. It's also got MVRV. It's got a whole different. It's got like 9 of them, I believe, and it just gives you an aggregate. As in the score here, you can see. But right now we're in that red, orange region, so we're sitting around the 70th percentile in terms of a score. Typically, when we reach those euphoria peaks, it's around 90, 95 to 100. But yeah, it can definitely heat up and then it's not the top yet. So I wouldn't get too worried that we're in the 70th region, and people are thinking it's the top. I wouldn't freak out about that.
And I just love how all of these things tell the same story, right? Like that's ultimately the objective. It's if something stands out and says something very different, we got to pay attention to that one and figure out whether it's the right metric to use or not. But so far, everything seems to be telling us the consistent story right back from the very first chart that we showed. So that's where the power of all this comes. Now you go down one additional path with this analysis, which is looking at sentiment, and it's something that's really important. So do you want to step us through? You've got 3 sentiment measures, and we looked at these last time. What's changed between last time and now, like over this last month, and where are we?
Yeah, so this one's more the bigger picture, as you can see. And nothing's particularly changed much. We're still at those quite greedy levels, actually. I think we did peak into the extreme greed for one day, I believe it was. I believe we hit 91, but we're below that now, sitting at like 79, as you can see. So as a rule of thumb, it's more so, when the market's extremely fearful, you look to buy. When it's extremely greedy, you look to sell. But that doesn't mean just because we're at the highs right now, doesn't mean to sell, because we can sit at these highs and it's not the top. We've had that in previous cycles before, and it can stay there for an elongated period of time. So I just want everyone to know that, rather than it hits the greedy section, everyone's like, I'm going to sell now. We can also have periods of we reach that and we consolidate, and it sets back at the lower regions.
Now, Joe, last month I remember this was one that particularly was interesting for you because you spend a lot of time sort of looking through all the chats, all the social media to get a general sentiment. What's your feel, before we get Isaac to sort of pull this one apart here? What's your feel of where we are right now?
Well, like Isaac was saying, I think up until about a week ago, I would definitely agree with the previous chart with that very high sentiment. I think there's still probably the sentiment's definitely pulled back in the last couple of days from what I can see. People are starting to argue. They're starting to call each other's names. They're starting to rip on the other people's coins, especially when you look at the meme coins. They're all laughing at each other, taking the mickey out of them. So the sentiment's definitely fallen. I think it can probably get worse from here. If we have some consolidation sideways action, and you definitely get those alts bleeding against Bitcoin. So I think in the short to midterm, I don't see it shooting back up to those high levels of greed very quickly, to be honest.
And when you talk about that bleeding, that's, Solana's been a favorite for a lot of people in this cycle for quite a while now, and we saw that make a new high. I mean, we don't generally focus too much on the alts, but we saw that make a new high, and really a lot of excitement there, but it's pulled right back quite quickly. So, you know, I think that feeds into what you've been saying. Isaac, is this what we see on this chart? Is that reflective of what Joe's just said?
Yeah, I think it completely is. And especially that the metrics here of social media. The thing is, on crypto Twitter and all those different places, people switch because a lot of them aren't following frameworks. They're just looking at memes, they're looking at news their mate says. And as soon as they feel affected, you know, they see their portfolio, you know, reduce a little bit, they'll freak out. And without seeing that bigger picture, I can see how it happens. And it's reflected in the sentiment score here. So this one really chops this sentiment score. It can go up and down, fluctuate much harder than the previous one.
Mm-hmm.
This just gives you that outlook on the more social media side of it. And we know crypto Twitter can just fluctuate so much in terms of sentiment.
Yeah, and that's really useful actually in terms of the previous analysis being more slow moving, if you like, and this being our faster moving, giving us that insight at the moment. But there's probably nothing there that's necessarily negative. Remembering the worse the sentiment is actually it's an inverse correlation, right? You're meant to be optimal to be able to push the market higher when people are negative on the market often.
Yeah, and you can even just look at it right there. Like, look at the sentiment score for, you know, when the ETF, right? It was decently high and then it dropped really low.
Yeah.
Just to the right side more. Yeah. A little bit further.
Oh, because when you're talking about the actual
ETF,
yes,
that's the ETF section there.
So this was all the anticipation, and then we get it, and then it's down. Yeah, and we're right back down those levels, aren't we?
Yeah, which is I think you're awesome to think about.
If you talk about the volatility in those lines, like you got Bitcoin Talk, Reddit, Twitter, you know, you can throw YouTube in there as well. Remembering they're entertainment platforms, so you've got to look at whatever's going to sell the news at the time. So if they're selling the doom and gloom, and people are freaking out, and they feel like they need to watch it, it's only going to reinforce whatever is being sold to them in a sense as well. So no, I think it's a great indicator. The more I think about it.
Now, if this is our short-term noise, this last one, which you look at, which is the Google Trends, is probably somewhere in the middle, actually, to be honest, of that longer term one we looked at first, the very rapid move, and then this idea of what people are searching for. What's that telling us, Isaac?
Yeah, so as you can see here, we had that ETF hype that came in, and then we also had quite an increase since the Bitcoin broke its all-time high. So people saw that. News articles started flashing, Instagram's Bitcoin's reached its all-time high. I even had some mates text me, hey, look at Bitcoin, it's reached its all-time high. So that's like giving you that score saying, yeah, a lot of people are starting to catch eyes. But I don't, looking at it now, it doesn't look like it's at a level where people are actively getting involved, especially retail. And you can even see it starting to reduce there too, since Bitcoin's broken its high. So to me, it hasn't reached that euphoric level. And even just feeling it based off what the market's doing, it doesn't feel like we've reached that level yet.
No, that is absolutely what that's showing, is as far as I can see it. We've had these levels before, and for people who are thinking, oh, well, you know, everyone's really bullish at the moment, well, that's kind of telling you that they may be bullish, but it's not broad. I liked how you said retail, right? Look, talking broadly, we're going to see these figures, these lines definitely go up if it's broad based, because Google's where everyone goes, right? That's the first place you're going to search. So this probably does indicate a lot of new interest as well, as opposed to people already in it, which will be more reflected in those previous charts.
Yeah, and I feel like a main important factor is here, the baseline of it should always be getting higher. And as you can see there, it has. As adoption increases, more people interested in cryptocurrency, the baseline increases. And that's the main important thing in terms of getting people into the network.
Okay, this monthly Bitcoin analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy, sell, and swap gold, silver, platinum, and crypto online, or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for security of real-world precious metals combined with the flexibility of blockchain. Okay, we're now going to look at something that's been very topical this last month. I know personally been looking at this every day and just blown away by some of the results, and it's those ETFs and what's actually been going on with them. So, Joe, I'll hand it over to you here to just give us that big picture overview of an area we've really been riveted and really paying a lot of attention to.
Yep. So first thing, just in the x-axis down there, just disregard the excluding GBTC. Yeah, I don't know why that's there. So obviously, I'll just quickly touch on where we came from. So ETF launches January 10, all which converted GBTC, the biggest Bitcoin fund, into an ETF. So that's why it's all the Bitcoin was in GBTC at that point in terms of an ETF. Over time, over the last couple of months, with GBTC has lost funds for numerous reasons, either fees or profit taking, or you look at liquidations from Genesis and other things that happen during the FTX debacle. But as you can see, we're still growing quite significantly, particularly over the last month. As we move into the next chart, we'll see the actual inflows in Bitcoin per day. Yesterday was actually quite interesting. We had, if you look over that negative outflow of 2.3 thousand Bitcoin, I think GBTC had an outflow of 650 million. And that was due to, I believe, the Genesis liquidation, where they basically had to give the creditors their Bitcoin back. But apart from that, if you're looking over the last month, it's just been an absolute cracker. The amount of Bitcoin that these ETFs are sucking up is it's just off the charts.
And we have not had a lot of negative days here. Like, you can count them on one hand.
No, that's right, and that's been reflected in the price as well. So price and sentiment. I think today we had 400 or 450 million outflow in GBTC. We're still waiting on BlackRock's numbers to see if we come in at positive. It might be a slightly negative day. We'll see how we go. But also, at some point, those GBTC flows stop, like those outflows. So people, like, the liquidations eventually will end. Like
going back to this chart, at some point we run out of blue, right?
Yeah, that's right. So the creditors get paid, and even though GBTC charge a 1.5% fee for their ETF, which is about 6 times higher than everyone else, the people in those funds aren't going to take a 20-25% tax hit just to save 1.5% a year.
Yes.
So it's really forced selling that's what's going on in GBTC at this point in time. Either forced selling, or people who are specifically not looking to hold Bitcoin long term, which is what ETFs are for. People that just wanted to trade that arbitrage early on.
Well, and some people were making the point in something I was listening to that you've got many years of fees built into that you've already paid. Like, the reality is you already paid it because you're in there at 1.5% when you compare that to the tax on the capital gains of pulling the Bitcoin out. So people are going to do that at an optimal time. And I agree with you. That means it's the outflows taper off at some point and stop from that fund, at least for that reason. They're not doing it for fees. They're selling for other reasons.
Yeah, I just don't believe in the fee argument, to be honest. If you have to pay income tax on your gains, which every single Bitcoin in that fund would have, I don't understand why anyone would do that. It makes no economic sense. Last chart is I think last month GBTC was still the largest holder of Bitcoin, and it still is. However, it's been overtaken by the other 9 ETFs.
The collective, yeah.
And also, as we can see, MicroStrategy is just becoming a smaller and smaller portion of the market. So, we obviously still get excited when they raise $600 million like they did yesterday, and they go and hit the buy button. But when you're looking at the impact of what the ETFs are going to do, particularly when you look at IBIT, which is the BlackRock one right next to it, they're going to take a larger and larger portion of what the market, they're going to absorb more and more Bitcoin than what MicroStrategy are ever going to be able to raise in debt funding.
And that could be a really powerful thing and really important thing for the market as a whole, because I know there was the Raoul Pal and Peter Schiff debate, or debate would be a compliment, I think, to whatever that was from some of the arguments made there. But if you look at MicroStrategy, one point that was made was, well, at the end of the day, that's still a company, and buying Bitcoin may be a good idea on debt, it also may not be a good idea. And even though we all love what Michael Saylor does, and we would say, he's done a lot for the industry as a whole, there is a risk there that all that Bitcoin being tied to a company that doesn't have the same restrictions as what ETFs have could create problems in the future. So the smaller that bar is probably actually healthier for the ecosystem as a whole. Would you agree with that?
Yeah, I definitely agree with that. And when you look at ETF, that's diversified holders, whereas MicroStrategy is effectively Michael Saylor and his board. So I'd rather more Bitcoin be in the hands of diversified holders than a single company. Even though, like, if you think about what Michael Saylor has done over the last 3 years or nearly 4 years now, the reason why a lot of those funds are in ETFs are probably because of him. So you can't have one without the other.
In no way is it casting any shadow on his accomplishments there. But if you look at just in terms of being anti-fragile, the system itself,
yes,
it makes more sense to not be in MicroStrategy the bulk of the Bitcoin if you're looking at it passive, like objectively as an observer.
Yeah, I agree with that. Diversified is always better. Diversified holders. So.
Yep. Okay, so that's the ETF sort of angle. We've covered, going back to our big picture, we've done the macro, we've looked then specifically at the Bitcoin market. Now we get into the weeds a little bit on the technical analysis. And just to reiterate, probably, and I think I would have said this last time as well, our opinion on the technical analysis, it is a very valuable tool, but it's a valuable tool when you look at all the other parts as the whole picture. So many people just live and breathe technical analysis and refuse to look at the underlying drivers. And that's often where you get a lot of these predictions that are all over the place, right? Like the Bitcoin's crashing to $5,000 because it needs to fulfill this pattern, or it's heading to $5 million because it needs to fulfill this pattern. I think the more sensible way, or the more conservative way to approach it all, is to look at the big picture first and then see, does it align with what some of the technical things are showing us? So with that in mind, let's have a look at what you've brought here today, Isaac, with this concept of Bitcoin cycles and a few other of the specific technical analysis things you want to look at.
Yeah, completely. So the reason I brought this one on opposed to the last one where I didn't add this is I just wanted to know we're approaching that halving phase, and during that region, we often do see price start to fall. So I think it's very normal for that to happen, and people freak out, as I was saying before, when price starts to fall. But we need to understand that's normal for it to do that. And I know people are saying it's different this time because the golden region, the Fibonacci has been broken, and we're at all-time highs before the halving, which hasn't actually happened. We've got to give credit to that. That is the first time it's done that. So it is different in a bit of a way, but don't be phased out if we collapse, 20% from here, to be honest, in my opinion. But that's just opinion at the end of the day. And you can go off all these technical things. And as you said, the main thing is that macro framework, right? But yeah, looking at where we are, we still have so much longer of the run. I guess you could call it the bull run. Looking at the green line I've put at the top there. So, we're nearly halfway, I guess you could say. And this is not the region to be exiting, in my opinion. So just based off the cycles here.
So giving that as that sort of bigger view of what's going on, you then zoom in and look at things like support and resistance. And these, you made some very good calls on this last month about when we were approaching, because we hadn't broken those highs last time, and you were sort of looking at these levels. How did that play out? Did it work? Did it not work? Tell us what happened there.
Yeah, so in the last episode, if you watched that one, I was talking about a few levels. I specifically spoke about the all-time high being an important level where a lot of traders specifically, and also spot holders, will start to exit their positions, whether that's leverage or just people want to secure some profits. And we also had some levels along the way going to the top. It was like 57,000. And there's a few others I can't remember off the top of my head, but we did see some nice pullbacks from those regions. And those weren't strong levels. A really strong one was obviously the top of the all-time high, right? And as you can see here, we've closed on the weekly, actually with that bearish candle, and we're starting to get a bearish engulfing candle coming down there, as you can see. Now that's perfectly fine. That's perfectly normal. And it ties in with what we're seeing with global liquidity starting to take on the back burner there. where consolidation phase is probably actually the healthiest thing that we can do right now, especially tying that into our RSI and stochastics. As you can see there, we're starting to roll over momentum wise, and we are getting it out of the frothy section, probably going to be coming down further. Now, on the weekly, I've highlighted a very important level, in my opinion, which is around the 51,000 region. Now, again, I would like to say these are regions, not specific numbers where people look at. A lot of traders will be like, it tapped this region, this exact dollar. That's not what we're here for. We're here for a region. And especially on big time frames like the weekly, that's what we're looking at. This one is a support level. And as you can see, that dates back. You got a few taps there. It's a level where we could look for a bottom in terms of we're matching it with momentum too for a potential consolidation range. It'd be nice to form a range there. I think it would be very healthy, and then we can consolidate there for a while, heading into the halving. And then from there, we look at global liquidity and see what that's doing. I'm not going to forecast what that's going to do, but look at the ISM and all those different indicators we've got there, and those macro tools, it looks like we'll be heading higher in the coming months, taken on the back burner for a little bit, but that's perfectly fine.
And that's my favorite part about this analysis here, is that it did line up, and we could effectively, we're seeing why this is happening, right? Like, this isn't a surprise to us, because we're seeing that little bit of fall in momentum in global liquidity and some of those other issues. And we were talking, I know ourselves, we've been talking amongst ourselves about April being a really challenging month ahead. But then what on the other side of that, it all starts picking up again. And this is what we're seeing line up with the technicals. So even though you say that support's there, that's not in any way saying that we get to 51,000. It may happen, and we may cycle through that. But also the market might say, well, we've had enough of a pullback here, and we can see what's coming on the other side of April. It's not that far away and I'm not saying also that the pumps are turned on the 1st of May, but we know that it's coming, right? We know more liquidity is coming into the system. So people looking at the market might be going, well, okay, we can see that, and we start to front run it. But the point is that identifying why this pullback has happened, and also what we said right back at the start when we're looking at those ISM numbers, that we don't expect it to stay down low, gives you that confidence to potentially buy this as a dip.
Yeah, 100%. And that's what we're looking at, especially when we go into the daily. We're highlighting more levels on the local term time frame. I just did the weekly with that one there because it's one of the more bigger ones. But here we can see we've got some more here. Specifically, I've got 59,100. That's the liquidity wick, as you can see at the bottom there. In my opinion, I feel like a lot of traders are probably putting their stop losses down there. I have experience in trading these types of price ranges, and it always comes down to those regions, whether to do another swing flow pattern and go up higher, or whether just clear them out as a liquidity region. But yeah, this is a level I'll be looking at too. And looking at the indicators there, I guess you could see, but that's why I don't like to look at on daily timeframes. I don't like to put too much weight on it, because it just doesn't, it's those smaller term timeframes that I don't really want to be putting too much weight on. Weekly more so.
But I also do agree with that. We're talking about that specific wick there, and that is a logical place where you would put a stop loss, right underneath that, and that's what markets like to do. So that one does make a lot of sense to me, and that doesn't break any of our fundamental analysis at all. That's just normal movement, and even the 51, it could certainly go there. But there's a difference, and I suppose that's the value of this daily here. There's a difference in saying, well, here's a specific target quite close to where we are now that you want to be on the lookout for, versus it's definitely going lower, because that's, it just needs to. There's a big difference in those two statements.
And what I find is the market always tends to wreck retail traders. And, all the YouTube videos telling you how to trade, they always say, place your stop loss below the wicks. That's the thing. And it always tends to hit those regions and wipe people out. So you got to be looking at these regions, in my opinion.
Absolutely.
With regard to that wick, Isaac, sorry, just quickly, with regards to that wick, you're talking about stop losses on shorts, would spot buyers be looking at that and be placing spot orders there potentially where would add support? I don't know, is that
you'd be talking stop losses?
100%.
I'm talking about actually just spot buyers looking at that wick and spot going, right, oh, I'm happy to buy it 59, 60 grand. So they,
again, it's just a region, right? Some people buying spot might not think it's the strongest region per se, but we're going to be matching with other different things like CBD. I'll be looking at too at that point in time. But this is just more so the trading aspect. But it gives you, it can give you that perspective on where to start. If you want a more DCA into, say you have more cash you want to deploy in the market, you can be looking at this to be like, yeah, I might. This is a decent region to start piling in some. But yeah, as you said, there could be spot buys there, and you could also start to see a divergence on the CVD line too, which we'll see what happens when if we reach that region.
Yeah, now, this was one you specifically talked about last month, about what we could expect if we broke the highs. So how did that play out?
It's actually played out quite well, actually, because I remember we were saying if we break the Fibonacci level, it's probably going to be a very bullish sign.
And that was these levels here, where it was, and it certainly did.
We cleared it out.
Yeah,
we cleared it out all the way to the top. I wasn't expecting to do it that fast, or I wasn't even, because we were at that point in time when we were doing the video. I think we didn't yet break it, so I was either expecting consolidation, or we had that other second perspective where if we do break it, it's going to be a bullish sign, and that played out quite well.
Nailed it, man.
Yeah, no, that was very good. Now this, I really love this chart. If you can step us through what's going on here, because I think this is probably one of the more valuable pieces of data looking at what's going on right now in terms of that pullback.
Yeah, so I guess I'll start with the left side of the chart there. So as you can see with the green, I've just highlighted bullish divergences. Now this is the CVD line. It's essentially telling you where there's a lot of shorts occurring. And what that does is if you see a divergence there, and if price isn't following it in a 1-to-1 ratio per se, what tends to happen is there's someone or a lot of people using limit orders to buy that up. Now, as you can see there, we saw the CVD line on quite a strong angle going down. We had open interest going up, which means there's new shorts entering the market, because open interest is essentially new contracts entering the market, whether it's long or short. And that's why we use CVD to tell which ones they are. And with price, we saw that was just flatlining. So even though it's flatlining, that can still produce a bullish divergence. As I said, 1-to-1 ratio is what you'd like, what would be normal, right? So you can see there's a divergence there. And from that, we saw that rise up, as you can see, into that next phase. Whilst, you saw a lot of shorts were actually being closed out going up there. As you can see, the open interest was declining, and then your CVD line was going up. So they're being forced to buy back to either liquidate their position, right? So you had the exact same two things occurring on those other green sections I've highlighted there. And I would just like to say with this red one we've got, it's actually a healthy correction, in my opinion, because we're seeing a 1-to-1 actually. We're just seeing longs close. So we'll see what happens in the future. Like, there's obviously shorts entering, but as a whole, I think this majority of this is caused by people leaving their positions, spot holdings, and then also some futures markets taking profits here too. So, yeah.
And I think, that's the part that was powerful when you were explaining this to me earlier. This idea that the correction, you can actually identify whether the correction is healthy or not based on what's going on. And we haven't got a lot of speculators coming in anticipating anything other. This is just a pretty orderly sell-off. Yeah,
100%. And we'll see what happens going into the next few weeks or so. But, we can start to see divergences from there. But healthy so far, in my opinion.
Okay, well, that's great. We've covered all the three things we wanted to do. I think that framework works really well. So we've seen that big picture. We've seen what's happening in the Bitcoin market and ETFs and everything around that. And then we've looked at some of those technical levels and the specifics there. So let's wrap up. I'll go sort of around. I'll start with you, Isaac. Final thoughts, where we are, expectations for what the month ahead has based on what we've looked at today.
All right. So my final thoughts are, I believe consolidation is what we have in store. Whether we decrease more 10 to 15%, that's not the point. I think we're going to be entering a region of consolidation for a while, going into the halving. And from there, I will specifically make a base judgment going over our framework again. Mm-hmm. But I'm personally expecting consolidation. And it's normal to expect that at this region too, going into the halving. Just because we broke the high early doesn't mean it has to be completely different. We have to shoot up all the way to the top. And if anything, it's going to be more healthy. We can also raise that realized price, as I was going over before, in the MVRV ratios. which will be more healthy for a push up later on. But that's my perspective right now.
That's great, Joe.
I agree with Isaac. I think there's a high chance or likelihood that we go into a consolidation, and by the time we're talking next month, we're still potentially hanging around the same price, within a tight range of where we are now, potentially even lower. So what I'll be personally monitoring is the ETF data to see how sticky those ETF buyers are. So this is obviously the first time we're going to go through that they've ever been through a 15 to 20% drawdown. If it gets to 25% drawdown, that's really going to test them. So I suppose in a month we'll know that, how they're actually looking at the market and how long term their view is. But apart from that, I would, if you're looking to buy, now's not a bad time. Not financial advice, but also be prepared that we can go lower.
That makes sense with everything we've seen. I think I'll sort of wrap up with my perspective on it. I've been asked just today by a couple of people actually about, should I buy now, right? Like you get that, friends and family, they'll ask you. And my answer to them has been, based on everything we're looking at, it's certainly lower than the highs that we got recently. So, any price lower than the highs is good from my perspective, because I see everything we've looked at, when you look beyond the next couple of months, that we probably head into that much higher price territory. So now any dip, this to me, it's a buy the dip opportunity, right? And that's always dangerous, because particularly when you've been through a few of these cycles, when you're in the bear market, every week, every month presents you with more buy the dip opportunities, right? Because it just keeps going down. And that's really what burns people. I think that's the importance of the analysis that we've done today, is that we're saying we're not in that phase yet. So we are expecting higher highs. We're expecting to make new all-time highs at some point over the months ahead. So anytime that you can get in lower than that makes sense. Obviously, it would have made more sense if they listened way back at the start of the cycle when we're making that point. But, that's the reality of people. They're always going to come late. Probably they're not too late yet, would be my summary. You're not too late to still position in this market yet, because taking it right back to the start of our macro cycle, we're still early cycle. Taking it right back to our global liquidity index, we're not even at the 50 halfway mark yet. All of those other things we looked at, the weight of evidence would suggest that we've got higher highs to come. So on that background, I think it still makes sense to buy for people who aren't in yet.
The risk is not being in the market.
Absolutely. And that I would absolutely agree with that. The bigger risk they have is that they wait, because ultimately they'll capitulate right at the worst time, at the real top, and not be in. So yeah.
Yeah.
Well, thank you, everyone. Thanks, Isaac, for all your work on that today. Thanks, Joe. Really appreciate all your time. I know our audience does as well. Remember, leave any comments that you have on anything that you've seen today, or anything you'd like to see on those social media platforms, and we'll certainly read all of those and take them into account. So thanks, everyone.
Goodbye.
All right. Thanks, Chris. See ya.
Thanks, everyone. Thanks for watching. We'll chat again soon.